to an analogy to the Mahabharata. Similarly to how Abhimanyu knew how to penetrate the Chakravyuh formation.
You can choose even a concentrated portfolio. You can choose
Welcome viewers. This video will be special for you because today I am accompanied by a fund manager who is not only popular in India but also has a commendable track record in the UK. Yes, you guessed it right. Mr. Rakshit Ranjan, a Chartered Financial Analyst and one of the co-founders of Marcellus Investments. Sir, welcome to our show.
Thank you. Thank you for having me.
You were running the whole show in Ambit. If I talk about your signature bet, coffee can was the most popular. So what different USP and investment philosophy you have implemented in Marcellus?
Okay, so there was a book we published called Coffee Can Investing.
Yes.
That is the philosophy which is the bedrock of what we do at Marcellus, particularly as a starting point, where we say that, look, coffee can investing effectively means buy into companies which will be prudent capital allocators over long periods of time. And if that is what we define as greatness, then such great companies put in a portfolio like you used to put your, prior to the banking era, in fact,
Yes.
you used to put your family jewels into a can of coffee,
Right.
empty can of coffee, and hide it under the mattress. On that basis, this term coffee can investing was coined by
Okay.
one of the capital group fund managers in the early 1980s,
Okay.
using that as an approach that buy into great companies, hold them for a very long period of time. It yields remarkable results. That's the bedrock of
Right.
our philosophy at Marcellus. Obviously, what we do here is an upgraded variant, a value-added variant of what we published in Coffee Can Investing book, where here at Marcellus we've got a team of analysts who collect data around evolution of greatness of these same businesses from the grounds level,
Okay.
and hence in a way overcome some of the areas in which you can actually add extra value on top of the filter-based coffee can
Right.
philosophy. So otherwise the philosophy is very similar. At Marcellus, in most of our portfolios, we have between 13 to 15 stocks,
Okay.
very concentrated portfolios. Churn rates are very low. So for instance, in consistent compounders portfolio, in the last 1.5 years, we've had zero churn in the list of companies.
Okay.
There's been no change to the list of companies. So typically, you would see one stock entry, one stock exit in a year, which
Okay.
is roughly a churn of say no more than 10%
Right.
in the portfolio, and hence an average holding period of a stock being longer than 8 to 10 years at least.
Perfect.
So that's what we do here.
Okay. So now I would like to bring a favorite question from my clients: why they should opt for portfolio management services?
Okay. So portfolio management services are first of all meant for more aware investors. That's one of the reasons why the regulator has also put a 50 lakhs minimum ticket size as an entry point for any PMS account.
Okay.
So if you don't want to invest 50 lakhs, then you can't open a PMS account for a smaller amount. And the reason for that is this wrapper, if I were to call it PMS, it is meant for more aware investors
Okay.
who want to choose the philosophy, who want to be closer to the asset management company, who want to interact with them. And they can, as a result, do their own due diligence on an ongoing basis as well, build trust, and get a solution which is otherwise not available via, let's say, a mutual fund
Right.
product, or in an advisory avatar, or in many other avatars.
Right.
So that's the incentive for somebody to come for a PMS, where you get customized access,
Right.
or you get actually, let me put it this way, you are closer to the fund management philosophy. And hence, if you're aware of what you want, you can choose even a concentrated portfolio, you can choose a specific philosophy by interacting with the fund management team, so on and so forth.
So you can say that it's more like a customized solution for an investor.
Yes, customized solution. Although, just to clarify, it's not that at Marcellus, where we have more than 9,000 accounts, every account has a different solution. That's
Right.
not the case. So we run a particular philosophy,
Okay.
which is different from what others might be running.
Right.
The PMS solution allows us to customize the philosophy the way we
Right.
can sharpen it in the best possible manner.
Okay.
And that is the customization that all of our clients get. Otherwise, all clients for instance, in consistent compounders, all the clients that are there, they get the same portfolio. So they don't get any different portfolio from other clients in the same philosophy. So customization doesn't mean in the same product, you'll have two different portfolios. Customization means you'll get something which you might not have otherwise got in non-PMS options
Okay.
to a client. Yeah.
Okay. So the previous day, I was going through a research report of Marcellus, and I could see a stock under coverage having a Moat score. So what is the Moat score, and what is the significance, and how do you calculate it?
Okay. So, I mean, that's the foundation of greatness
Okay.
in any business that we assess. Moat effectively, I mean, the term moat comes from, so there used to be castles previously in the olden days. And to defend from attackers, which in the case of a business could be competitors, to defend against competitive attacks,
Okay.
moat is effectively like a sort of a defense around a castle,
Okay. Right.
which used to be a sort of trench in a way, a deep trench, which protects the business from either profit erosion or market share erosion
Okay.
every time a competitor comes in.
Okay.
So just to give you an example,
Mm-hmm.
let's say when you go out and buy a car,
Okay.
four-wheeler,
Sure.
right? Certainly you might like the brand, you might like the design,
Okay.
but there might be two or three companies catering to the same segment
Yes, it happens.
of the car. Now, if one company decides to offer 10 or 15% extra dealer margin
Right.
compared to another business, then your decision making does get affected by
Definitely.
that 10%, that 15%, right?
Right.
Lower price on the same segment offered by somebody else.
Right.
And that's where somebody can actually undercut on price and take away either your profits or your market share
Right.
as a competitor, right? Take, for instance, an example of a Unilever versus a Colgate.
Okay.
If a Colgate is offering buy one, get one free on their toothpastes,
Right.
and Unilever doesn't offer, then it's a very likely scenario that some customers of Unilever toothpastes
Right.
will switch over to Colgate
For sure.
for that buy one, get one free.
Right.
And hence Unilever will either have to compromise on profits and offer the buy one, get one free on their products for the time being,
Right.
or they'll have to let go of market share.
True.
Right. So either way, Patanjali did this to Unilever for a couple of years. Now, this might not sustain, as in Patanjali might not sustain as a competitor against Unilever beyond 1 or 2 years. But for that 1 year period, they could put a dent to the profitability of Unilever. So that's one example.
Right.
Consider another example, which is, let's say, Tanishq in jewelry.
Okay.
The main revenue is making charge for Tanishq.
Right.
A competitor comes in and offers lower making charges. Customer won't switch over from Tanishq to, let's say, Kalyan, Joy Lucas, PC Jewelers, TPC, or local mom and pop just because of a lower making charge.
Right.
In fact, large part of particularly the mom and pop jewelers, they all offer lower making charges than Tanishq,
Ganesh. Right.
but the loyalties don't switch for that 10-20% cheaper price point,
Right.
right? This is an example of deep moat.
Okay.
There's a reason why this happens. This is like a defense against competition. Now, I'm giving you one format of it, which is around pricing.
Right.
This could be around various other activities that companies might do in order to gain market share from an incumbent.
Okay.
The moat of the incumbent will be the defense against market share loss or profitability loss.
Perfect.
It's very important in our philosophy for the companies that we invest in to have a very deep moat.
Okay.
If that is not there, then you will always have a new competitor coming in. So, for instance, to give you an example, Asian Paints is one of our larger allocations in the portfolio. 15 years ago, world's largest paint company, Sherwin-Williams, came as a competitor to Asian Paints, and they offered cheap prices via greater dealer discounts to the channel. 10 years ago, Norway's monopoly called Jotun.
Okay.
Jotun is how they spell it. Jotun is how they pronounce. They came in 8-10 years ago. Nippon came in. 4 years ago, JSW came in. Next year, Grasim is coming in, and this will not stop.
Right.
If Asian Paints doesn't have a deep moat, then every time such a competitor comes in,
Right.
either Asian Paints will compromise on its margin as a defense or let go of market share.
Right.
A deep moat will help protect both, which is what we want in every company that we invest in. How do we score it? So now in our portfolio, in a typical portfolio, there will be companies across different sectors.
Okay.
So the moat of a Titan will be different in construct than the moat of an Asian Paints.
Okay.
But we still need to compare
Okay.
so that we give higher allocation to companies which are better quality businesses. One of the inputs into defining the quality is moat. There are other inputs as well. So it's not just the moat score which defines position sizing, but what size should we give to a particular company's position? One of the inputs is the moat score, which we then quantify through a very granular breakup of what constitutes the moat.
Okay.
And hence we score it on a certain scale.
Okay.
So that we can compare two companies' moats with each other, even though they might be from different industries, different constructs, so on and so forth.
Okay. Quite satisfactory. Can you just brief about your flagship product, CCP, and for which clientele it can be a suitable product?
Right. So CCP is a product which invests in companies that have already got longer than a decade of consistent capital allocation track record to begin with. And then we can understand the reasons why this consistency of capital allocation will be sustained in the long-term future as well.
Okay.
Right? Effectively, we are buying into institutions rather than sort of businesses which didn't have a long enough history of being of going through several cycles, several disruptive attempts. They've been the disruptors in their industries. They've been through several management changes. They've been through lots of changes at the board of directors level, but still their strategy, still their capital allocation, still their approach has been prudent and consistent.
Okay.
And has been scaled up over a period of time.
Right.
Those are the kinds of businesses we invest in. The approach towards building the portfolios, we've got our proprietary fraud detection framework on accounting fraud. That becomes the starting point, because if there is any accounting challenge or red flags in accounting cleanliness, then our proprietary framework, which today actually runs on Python code, it picks it up, filters those companies out.
Okay.
Next, we want history to be of great capital allocation track record. And then our moat score, our capital allocation score, our institution building score, which is more around succession planning of the CXOs, decentralization of decisions at the board, so on and so forth. All of those aspects, they sort of come together to help us identify a bunch of stocks which are not only dominant, they are dominant and highly cash generative.
Okay.
They are not only cash generative, they are cash generative with a very consistent redeployment of that cash to drive growth.
Okay.
And hence a consistency of healthy compounding of fundamentals and hence share prices is what we seek. Now, this is the lowest risk product at Marcellus that we have, and the kind of clientele that we think caters to this is ones who want to use the foundation of their equity exposure through a bunch of stocks which don't give them sleepless nights.
Right.
Through fundamentals, at least, right? Share prices can be volatile in the short term, but fundamentals shouldn't be volatile over the longer term and in the near term as well. And that's where consistent compounders fits into a customers, into an investor's equity allocation as a foundation, on top of which high risk, high return products can be bought in addition.
Right. So are you leveraging more on the capital allocation part? Is it so?
Yeah, the capital allocation is the heart
Okay.
of the business. I mean, Moat is the muscle
Right.
in a way, but capital allocation is the heart. If you fail on capital allocation, then you won't be able to grow and you won't be able to sustain your core competence.
Okay.
Because effectively, capital allocation has to do three things. One is, if you build a great business, competition will certainly come and attack and try to have a slice of that greatness.
Right.
Right. So capital allocation has to keep deepening the moat,
Okay.
right, which we just talked about. Second is capital allocation has to also help build adjacencies as new revenue growth drivers, new capabilities, new ways of generating more cash in future. So for instance, to give you an example, Tanishq was the only source of value for Titan till a few years ago.
Right.
And now Carrot Lane, the Titan I Plus, Tanaira, Sardis, these are adjacencies which are capital allocation decisions taken over the last 10 years, some of which became successful new category expansions.
Okay.
And hence the business goes along, right? So Bajaj Finance started off as a consumer durables lender.
Right.
And today it is also doing home loans.
Right.
And fintech. These are all capital allocation decisions around changing the size of the canvas,
Okay.
or even changing the nature of your core.
Right. Perfect. So FPI activity muted in August so far, and we can also see some offloading of 2000 CR. So is it because of the hike in US 10-year bond yield? What do you feel?
Yes, that was the case till 4-5 months ago,
Okay.
where FII outflows were massive in FY23. And that's natural. When the interest rates go up significantly, long-dated assets will move away from equities into bonds. That can lead to equity outflows of FIIs. Which actually, interestingly, since you raised this point, our portfolios are far more FII owned than the broader benchmark.
Okay.
So when that happened last year, there were more share price pressures on our portfolio companies than on the broader stock market.
Right.
But these always are flow related, because this FII inflow or outflow doesn't change the fair value of a business.
Right.
Asian Paints' profits, revenues, free cash flows don't get affected by FII flows on Asian Paints' share price.
Right.
Right? As a result, the fair value doesn't change. If the current price goes down a little, it only becomes a greater opportunity, a better opportunity to buy more.
Right.
And over a 6 to 12 months, these effects, they reverse.
Right.
At times, FII inflow will pump up the share price. That will also reverse and normalize. Times FII outflow will pump down the share price. That will also reverse and normalize, which is what we've started to see in the last, say, 3-4 months.
So it's a part and parcel of the market cycles.
It occurs frequently, yes.
Okay. My last question pertains to an analogy to the Mahabharata. Similarly to how Abhimanyu knew how to penetrate the Chakravyuh formation, finding the exit strategy was difficult. Similarly, when an investor invests in a stock market, they find it easy to enter in a stock. But the difficult part is to finding an exit strategy. So how does Marcellus address and overcome this issue?
Right. So there are 3 broad exit reasons for exit from a stock. One is the fundamentals have deteriorated,
Okay.
and hence there's no point of even holding on to that stock. Two is the valuations have gone up to a level where you either don't want a large exposure and hence you want to part exit, or it has gone up to a level where you want a complete exit. Three is it's a relative call. We want to run a concentrated portfolio, let's say 14, 15 stocks. There was one stock which was outside the portfolio that became significantly more attractive, either because of fundamental reasons, our understanding of the fundamentals, or maybe share prices fell down, valuations became too attractive, whatever be the call, a reason. And that stock has to enter the portfolio.
Okay.
Now the call has to be made is, should we increase the list of stocks in the portfolio by one, or should we replace one of the existing stocks with the new entrant? And hence the existing stock goes through an exit. So that's a relative call in a way.
Okay.
So three reasons: fundamental deterioration, valuations, and relative call.
Okay.
We have to be very clear about how to measure these three aspects
Okay.
and how to not be biased when we have to take those calls.
Okay.
The more you quantify qualitative aspects,
Okay.
the more you run decision making
Okay.
via a, let's say, investment committee and a challenger process we have in our research team.
Okay.
It sheds your biases. It makes the process a lot more transparent for the decision makers.
Okay.
And hence you are able to let go of an investment, even though the share price would have actually, in many cases, you might want to exit because the share price did so well.
Right.
Which is where, if you're clear, it becomes easy, but otherwise you're perfectly right. It's a difficult call to exit.
So I would like to thank you for the session, power packed with knowledge.
Pleasure.
Viewers, I assume you must have enjoyed this session. Thank you for tuning in.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.